All right, how's it going? Hey, everybody, Jake and Gino here. And today we are discussing why you shouldn't fall in love with a deal. And I think this answer may not be as obvious as you think. Do you know it's a hot market out there? And now more than ever, we see people pressing at the plate. What do I mean by that? Could be like us, haven't done a deal in a while, you're itching to jump back in. You want to get your next deal. You're ready to go. Maybe you have a lot of investor money sitting on the sideline. You're like, let's go. Let's jump back in. Or trying to get your first deal done. You're saying, I got to get in the game, and you're growing impatient. Now, our group, we're closing on 6 deals in this last 4-month span. So we're busy, we're rocking and rolling right now. But last year, we closed on 1 deal. It was an 85-unit deal. That's all we did all last year. And I think this patience is key because depending on how big your footprint is, how many markets you're in, you're going to need to wait for your pitch. Otherwise, there's some serious issues that come along with buying a deal that does not work. Now, the GDAD is about to tell you that no deal is better than a bad deal. And I completely believe that in my soul. We relate owning multifamily apartment buildings to raising children. It's great to have a child. Everyone's excited. You're doing, surprise, what's the gender parties and poof and balloons and everything. But you have the child or you have the deal, then what? Okay. You're now responsible for raising that child or raising a sustainable cash flowing asset. And this is where the rubber hits the road. So Gino, G-Papa, you ready?
You told me you served it up to me on a platter. I'm still waiting for that platter, bro.
All right. So Gino, what are the pitfalls of falling in love with a deal when the numbers don't work or there's deferred maintenance beyond your team's capabilities?
Jake, it is November 2006.
Ooh.
I'm drooling.
Oh,
we just
meatballs.
After I'm eating my meatballs, maybe that's what happened. I had too much food in my stomach. My brain wasn't working properly. And we closed on a property in New York. I fell in love with the deal. Mixed use. It was just a beautiful property. I had pictures of what I was going to do to this deal. You talk about over fixing a property. Bam. You talk about buying a property not in the right market. Bam. You talk about buying a property in the wrong part of the market cycle. Bam. You talk about buying a property that has more deferred maintenance and has more issues and doesn't have proper C of Os. I made every mistake conceivable on this property. Do you want to know why? I didn't know buy right, manage right, finance right. And more importantly, I fell in love with the deal. I didn't fall in love with the numbers. The first thing that everyone needs to do, especially in this part of the market cycle, you have to create a budget and then probably add 20 to 30% on top of that budget and probably add another 3 to 4 to 5, probably 6 months onto that, because that's what's going on. Even back in the day when I had it, it was my first deal. I didn't have team members. It took me longer and I spent so much more money on this deal. If it don't cash flow, you let the grass grow. It's that simple. Now, you're not going to become super wealthy from cash flow, but it's going to pay the bills and it's going to put money into your pocket. Ultimately, when you refi the deal or you have that equity event where you're putting deals on what we call a conveyor belt, it will matriculate and you continue to create that equity in the property, and that equity continues to get put into other deals. Unfortunately, on that deal back in 2006, I didn't create equity. All I did was hold a property for 12 years that sucked the life out of me. And I actually lost money in the deal, hundreds of thousands of dollars in the deal. Now I got tax benefits from it. The residents, fortunately, for those 12 years, were paying down the debt, the mortgage for me. So some of that debt was reduced for me, but I learned so many lessons on that deal. You need to do your underwriting. I've got a pen in my hand. Don't pencil whip a deal. You really need to look at the numbers and make sure that those numbers work. You also need to make sure that you're in the right market. For me, back in 2006, New York was still okay. I was just buying too far away from the city. It was not an emerging market. There was no appetite for commercial rents. People still wanted to work out of their houses in their underwears. So you got CPAs who don't want to spend $500 a month on a simple little office. I didn't understand the market. I didn't understand commercial leasing. I didn't understand any of that. I should have gone and gotten a mentor to teach me about buying these mixed-use properties, but I didn't. I thought I knew it all. I thought I was getting a great deal. The only good thing I did with the property was I used creative financing. And then I refinanced it out right before the 2008 crash. So I always had good debt on the property. I bought wrong, I managed wrong, but I financed it right. And the problem that I had was that ROE. I want everyone to write this down because it's really, really important. It's the return on effort, not return on equity. It's the return on effort. I managed this property so poorly that I had the property manager calling me every week. We've got a problem. We've got a problem. Instead of firing that property manager, I had him there for 10 years. And that was my biggest mistake, not buying with numbers and not managing this property properly. I didn't buy on my budget. I blew the budget up completely. Talk about the Great Wall of China. I had these railroad ties. I replaced them with those cinder block things. That wall alone cost me over 50 G's when it should have cost me probably 10. You compound that with doing all the siding, doing all roofs, doing driveway, doing water system, doing
Sounds like you thought it was your house.
Dude, I'm telling you, I must have spent probably 400 grand more than what I should have. But it's one of those things when you go down the rabbit hole, you start fixing things. I could have avoided a lot of this sooner. I had the inspection report and I just said, you know what? It's not as bad as I think it is. I wanted to do a deal. I had money here. A person with money meets a person with experience. The person with experience gets the money and the person with the money gets the experience. I got a lot of experience in that deal. I would never take that deal away from me. I would never say to myself, I wish I had not done that, because that deal led me to multifamily, which ultimately led me to Jake, which is probably one of the best things that ever happened to me in the business world. So without having that deal and not understanding it, I pushed myself to say, these are all the mistakes that I made. What can I learn from this mistake? Right? I said, I want multifamily. I don't want to deal with commercial tenants. I don't want to deal with retail. I want apartments. I want people where they need a basic human need. And that has served us so well for the last 15 years because people need a place to live. Demographics have shifted. And as you can see, the office space is not what it was 10, 12 years ago because there are more people who are working remotely. So what I want people to understand is looking at a property, understanding what your exit strategy is. I had no exit strategy on this property. Am I going to buy and hold it forever? Am I going to sell it? I had no exit strategy. So going in there with a clear vision of what you want to do with the property, having clear budgets in place, having a clear understanding of what the underwriting is going to look like in the future is really important. Then working on the buy right, the manage right, and the finance right, putting all those three in conjunction and closing that deal and knowing what's going to happen with that deal in the future.
So I love you, man. This is fun. And I'm going to have a couple follow-ups here. So the buy right criteria, talk about specifics, how you missed on the buy right criteria, and actually tee up for folks what buy right criteria means. We don't got to go crazy with it, but what buy right criteria means and specifically how you missed on that deal.
Well, I had no buy right criteria back then. What was I buying? I was buying mixed use. I was buying commercial. I was buying multifamily. I was buying self-storage, mobile home parks. I was chasing yield. I didn't understand an asset class, and I had get-there-itis. I want everyone to stop.
You didn't have a market. You didn't have a specific asset class. You didn't have a vintage. You didn't have a population. You didn't have an income growth, all that. Okay.
Yeah. And that's your buy right criteria. When you're out there, let's talk specifically with apartments. You're looking at a 3-unit, a 10-unit, a 15-unit, whatever it may be. What is appropriate for you to buy? With Jake and myself, right now in this part of the market cycle, we're buying deals that are a little bit smaller. We're buying them within a 3-hour radius of Knoxville because we can. If you're starting out new, I encourage you to start out with one market. That's what Jake and I did when we started back 2011. We picked Knoxville. That was the market we selected. And then we started going within the submarkets. Start with one market. Understand the areas in that market where you want to be. What is the median income? Do you want it to be $30,000? Do you want it to be $40,000? Do you want it to be $80,000? Understand that also because you want certain neighborhoods. What type of unit mix? We like twos. We like garden style and townhome apartments specifically, if we can find them. Vintage, right now in this part of the market cycle, we're looking for assets in the 80s or newer. So there's a little bit less deferred maintenance. Now, let me take you back down memory lane when I bought my deal. That had none of that. I didn't understand the market.
No population growth.
There was negative population growth, right? There was no demand for the asset. I didn't know that. The commercial leases, there was no value in the commercial leases because there were no businesses up there. It was just something.
You bought a business building out in the woods, basically.
Yeah, it was a trophy asset. It looked nice, and I could see. I as an entrepreneur, you see the vision, Jake. You know, I'm a vision person. I saw the building, and I said, I'm going to turn this pig around.
That's why I'm saying you're looking at it like a house, though. It was the wrong.
Exactly. And I did a great job. The property looks beautiful to this day. All the signage, everything's there. Everything looks great. But I'm going to say 3 words that are truly important in multifamily real estate. It's all about the net operating income. Can you drive your net operating income and can you increase it? That's the bottom line. If you can do that, we're value add investors. If you can do that, then the deal makes sense. If you're buying it because, it feels good and it may
the
go
issue
up.
Wasn't what it looked like. The issue wasn't what the building looked like. It was the demographics. It was the buying criteria behind it. And you thought by making it beautiful, everyone was going to love it. There just wasn't the population in the demographics who support it.
And there wasn't demand. Correct.
Yeah. And so give me one little just fun management story or any disasters that went on there, because you also touched on that. So you did a great job financing, no buy right criteria, and then any crazy shit that happened on the management side.
There's a couple. The first thing was I walk in there. It's a well system. There's no chlorinator. The Board of Health shuts the building down because I don't have a chlorinator. But I said 3 weeks ago, before I bought the building, it wasn't working. Well, now you're the new owner. Oh, by the way, the fire sprinklers.
Yeah, New York.
there's no fire suppression. There's no fire alarm here. Yeah, but there wasn't one before I bought it. Oh, well, now you got to put one in. Oh, wait, there's an apartment upstairs. There's no apartments upstairs. There's no firewall. It's all commercial. I had to take that apartment out. The apartment down below, same thing. I had a person living in there for months. I finally said to the person, is Carlos home? The wife says, no. 30 seconds later, Carlos walks out. I said, Carlos, can you please give me the keys, cash your keys? Yes, I will. Never left the apartment. Total disaster. I'm looking at the window. The windows were chewed out because of the dog. There was dog crap everywhere. These are all lessons that I could have learned myself. When you're doing an inspection of the property, if there's no certificate of occupancy, if there's illegality as far as not having these systems in place, you can remedy them. I found an oil tank buried on the ground. I had to remove it myself. I could have had the person selling it to me remove it. How
much did that cost?
That wasn't that bad because what ended up happening is I had to remove it. And then I had to replace it, put it inside. So it cost probably about $3,000 or $4,000. That wasn't the end of it. But it's just the stress of, is that tank leaking? Is it not leaking? And then taking over leases from people who are in the building, it was just an absolute nightmare. But it gave me strength, as what we say. It's part of the grind. It's part of the learning process. I would never take it away. But it is that ROE, the return on effort. And that's why I implore all of you out there, if you're seriously considering getting into any niche, whether you're looking to multifamily, whether you're looking to self-storage, single family, find mentors out there who are doing it. And that's what ultimately led to my success, because I said, I don't know what I'm doing here. I need to find somebody. I ended up signing up with 2 coaching programs right after that. Then I meet Jake a year after that, and I already understand the business somewhat. We partner up, and then we buy our first deal, and I'm able to underwrite the deal properly. I'm able to vet the residents. I'm able to implement whatever systems I've learned, and that leads us to our second deal, which leads us to our third deal. And if I had not gone through that horror show of that first deal by myself, I never would be where I am right now, because
you didn't
there were
quit.
A lot of learning ops. Yes, you're right.
And you didn't quit. All right. So the pitfalls of falling in love with a deal: financial strain. The numbers don't work. Don't pencil whip a deal. If it's not there, it's not there. Be honest with yourself. Mm-hmm. Do you really believe in your budget? Do you believe in your thesis? Have you proven that the comps are what they are and you're going to be able to get your rents there? Maintenance strain, management strain. Is it beyond their ability? Okay. Are you really partnering with a group that knows what they're doing? Are you doing it yourself? Okay. You need to really dial in the management process, or you're going to hate what you're doing. Listen, so many people starting out, they may buy right, they may finance right, but they haven't thought through the management component, or they don't have systems, or they're not treating it like a well-oiled machine. They don't have a cadence of accountability. This is where so many people fail. Okay. Market strain, in Gino's point here. You can't change the market. It is what it is. He bought an office building out in the woods. It wasn't going to work ultimately. You got to know the market. You got to have buy right criteria. And all of this basically becomes a time strain that adds anxiety. It kills your quality of life. It kills your positive mental attitude. It might kill your outlook on multifamily investing and your broader goals. So a bad deal is never worth it, in our opinion. No deal is better than a bad deal.
Jake, if I can just follow up with something that I read in the book the other day, and it really resonated with me, and it really exemplifies my story. A smart person learns from his mistakes. And I obviously am a genius when it comes to it, because I made tons of mistakes. But a wise person learns from others' mistakes. And that's why we've created Jake and Gino, because the students there don't have to go it alone. We just said in another podcast previously, success leaves clues. There are a lot of clues out there. Go out and find a mentorship. Go out and find a community that you can learn from. Don't make all those mistakes yourself like I did. I made tons of mistakes between the 2004 and 2010, the Great Recession. I bought deals that I shouldn't have bought. I lost hundreds of thousands of dollars that I didn't have to. But we're all taught that I'm going to do this and I'm going to do that. You don't have to do everything by yourself. That's the important thing in life. Find out and learn from others. The wise go out there and learn systems and implement those systems from other people who are doing it. But just find people who are out there doing it and make sure you can align yourselves with them.
Final words, raise your children. Whether they're in your house or they're your multifamily assets, you got to raise your children. Gino, you the man. Really enjoyed this today. Thank you so much.
Thanks, Jake.